If you've ever spoken with a financial advisor, looked at a mutual fund prospectus, or heard an investing pitch on a TV or internet ad, you've likely heard or seen a line like this. Our strategy delivers an average return of 7, 8%, maybe 10% per year. The phrase average return gets repeated over and over as if it tells you everything you need to know about your future wealth projections. But here's the problem: the exact same average return can lead to drastically different wealth outcomes. Two investors could both average exactly the same return over 30 years, and one could end up with millions while the other runs out of money well before they're even halfway through retirement. How might you ask, is this possible? The difference between the two scenarios has nothing to do with discipline, spending habits, or luck. It has everything to do with when those returns happen. And that hidden factor is what I call the sequence of return risk. A risk so powerful it can make or break your retirement. And nobody's talking about it. That is, until now. Average return, after all, is just a mathematical calculation, the sum of each year's return rates, both good and bad, divided by the number of years in the sample. The sequence of return risk means that it's not just your average return that determines how much money you'll have, but rather the order in which the good and bad years occur. If the down years occur early in your retirement, your savings may never recover, even if the long-term average is impressive. That's why focusing only on the average return is not only misleading, but it's dangerous. What really matters is protecting yourself against when losses occur. And since you cannot avoid them altogether, being able to smooth out those inevitable losing years is essential. So here's a real world example. From 1970 to 2000, the S&P 500 delivered an average return of 14.9%. That's an incredible number. Now let's take a look at what would have happened if you retired in 1970 with $1 million investment account and you had $100,000 per year expenses. As you can see, withdrawing the same amount each year, adjusted for 3% inflation, would have been depleted by year 11. Now, if you flip those returns around in reverse order, in other words, the return from year 1 becomes the return of year 30, the return from year 2 becomes year 29, etc. Instead of going broke in year 11, you would have over $3 million in your account. And after 30 years, you'd finish retirement with over $14 million. The same individual year returns, the same average return, completely different outcomes, all because of the sequence in which each year happened. Now, during your working years, or what I call the accumulation phase of your life, you may not be as concerned about this risk since you're still working and you can continue to contribute new money and you have time to recover from bad markets while waiting for the eventual market rebounds. Even so, you're still going to end up leaving a lot of wealth on the table. But in retirement, or what I call the distribution phase of your life, well, now you're withdrawing money and time is no longer your friend. Losses cut deeper because the money you need to cover your expenses is now being obtained by selling your investments, often when the markets are down and the prices are low, which is exactly the opposite of what you want to do. And every withdrawal from your investment account permanently shrinks your bottom line, leaving less of a base to grow from when the markets do eventually recover. So losses early in retirement can destroy decades of careful investing and savings. So what's the solution? Well, since we can't control the market, we must control exposure to the market, protecting against losses each year, especially avoiding big drawdowns early. That matters even more than chasing the highest possible gains. Now, a strategy that adapts to the changing conditions of the market by limiting losses in downturns and participating in growth when times are good, that's the best defense against the sequence of return risk. And that is exactly what Compass Investors Horizon strategy is designed to do and has done for the past quarter century. Horizon dynamically adjusts your portfolio allocations based on actual market conditions. In favorable markets, it increases the exposure to growth, mainly stocks. In deteriorating condition, it reduces the risk to stocks to protect those savings. There's no sitting around doing nothing, waiting for the recovery to happen. By adapting along the way, Horizon smooths out those returns, cushions the downturns, and virtually eliminates the devastating effects of the sequence of return risk. So, to recap, average return alone doesn't determine retirement success. The sequence of returns, if you don't understand and manage it, can break your financial future. Losses early in retirement are especially dangerous and should be your focus to avoid. Compass Investors Horizon strategy is built to adapt, protect, and help you keep your current retirement security. Don't let sequence of return ruin your future. Click the link below to discover how Horizon can help ensure your money lasts as long as you do.